All right, good morning, traders. This is your free daily video from seasonalswingtrader.com. Today is Tuesday, February 7th, 2017. Hope everyone is having a great week. This morning, we are going to take a look at ROST, R-O-S-T, or ROST stores, dress for less. And we're looking at a seasonal trade that has displayed a 100% accurate seasonal bias to the upside over the last 10 years. And as you can see from my chart here, over the last 10 years, with a trade date of February 8th ending on March 24th, we've had a win rate of 10 out of the last 10 years, an average gain of 10.7%, no drawdown, and a cumulative gain over those last 10 years of almost 52%. So we are nearing the entry date tomorrow. I'm looking at the price action today. You can see here that we've got earnings on February 28th. I would not advise to hold the position through earnings, but we've got about 3 weeks or so here that we can possibly jump on board, see if we can get a bounce to the upside, and maybe exit before earnings. Keep in mind that we will have some option premium built in due to the upcoming earnings announcement. But I still think that we could possibly get in for a little ride higher before earnings, then take a look back after earnings announcements. Ideally, we'd get in a situation where earnings maybe pulled it back some, not too dramatic, but pulled it back some, and then we resume the trend higher through the end of March, because you can see that's where the meat of this trade has been. So let's look and see what we did last year. Here's 2016 in the white line. You can see that right after earnings, it did pull back some and then rise moderately higher. Here in 2015, we got the big earnings bounce, and then it traded kind of flatline there. 2014, also a bounce into earnings. That's what we would be looking for, and then a flat line into the end of the seasonal period. Here is 2013, kind of went counter seasonal on us. It traded lower into earnings, then got a bounce higher before falling back off the cliff there. Let's look at a couple more years. Here's 2012, pretty streamlined there on its way up. Here's 2011, kind of flat into earnings, and then drifted flat to lower towards the end of the month. One more year, 2010. That looks to be the most explosive year. We did get a pullback right along the entry date of the 2.8, but then pretty much turned higher and really never looked back. So depending on your overall risk tolerance, you can hold through earnings, and it can also create some complex option strategies around that. Just really depends on where the price action is going into earnings. So let's take a look at a live chart here. Today we're trading relatively unchanged, $66.30, down 4 cents on the day. The S&P currently is up 3 points, trading around 22.89. So the market's a bit higher. We're unchanged on ROST. And as you can see, not quite a clean, symmetrical wedge here, but we are doing some consolidation after posting this kind of double top, 1, 2, 3 top here at these levels. Trading back in here, consolidating around the 50-day, and looks like it was heading towards the 100, which it bounced off of. So what I'm liking here is possibly a 65-62 half spread, put credit spread, and the 65 level puts us right here, which means that I would be wrong anyway. I think if we start breaking here, breaking below this mini trend line, also would be a break below the 100-day. I think that we would be heading lower probably to test the 200-day average around the 62 half level, which would be our max risk on the strike. So if we go over here to the options chain, we can see a 65-62 half is currently giving us about 75 cents a contract, $75 cents a contract, with about a $2.50 overall risk. If you take out the premium you are receiving, you've got about $1.75 or so of risk there. So 75 cents. I think I do like this trade. 65-62 half. We've got our max risk cap below 62 half. If you want to go a little bit further, take a little bit less premium, we could do the 62 half 60 for 40 cents. Your risk reward is going to be a little bit less favorable, but 62 halves would take you all the way down here to the 200-day average. So can't sell both because that would wipe out your 62 halves, but looking at the 65, 62 halves for 75 cents and or the 62 half 60s for 40 cents and see if we can get a pop out above this trend line break here, back above the cloud, the 915 turning higher, and make sure to jump out of that trade before earnings. So that's what we've got cooking today in ROST, and we'll see you on the next update.